So this is structured research. It's a show built around an idea where you want to know what's going on with maybe the perspective of a finance pro, like a hedge fund manager or a banker or people who have hundreds of millions with these firms. But normally you wouldn't be able to reach this kind of research. So because of this and because of we feel that there's a demand, we created a service called Structured Research on Twitter. This is an account which tweets out and sends stock tweets messages out for well, basically snippets on what's important and what these big firms think about currencies, sometimes about individual stocks, big macro moves. And together with me is Michelle, who's going to help me talk about what's been going on. And she's also the co-owner of Big TV. Say hi, Michelle.
Yeah, hi. So I'm Michelle Valfels. I tweet under the handle Geneva Girl at Sardonica X. And I'm based in Geneva, as my handle would imply. I'm working for an asset management company, or rather sort of a small family office.
Well, you own one, don't you?
Sorry?
Don't
yes,
you own it?
Yes, it belongs to me. And I allocate money primarily to hedge funds.
Yeah, and I want to give you, you got some praise, both from me and Ed, before on the previous show, and you've been called by some very prominent people smart money, and I think that's a kind of a good. But I'm not going to give too much praise. Maybe people don't know who you are. She's fairly new to Twitter, and it's an obvious follow. So if you want to, she doesn't tweet as much as I do, for instance, but it's almost always good. So. Let's just get on with it. She had some interesting stats from hedge funds that came in.
Actually, sort of first, I mean, I'm sitting here in Geneva. I'm in my office, which I share with 4 other people. Obviously, not in a studio. So there may be sounds of
it looks fine.
People sort of coming in and out.
Yeah.
And
only your dog is the only thing.
I also brought my dog into work today. He's sleeping behind me, but he's liable to bark at any moment. So.
But you want me to bring up the first chart you had?
Yeah. Why don't you bring that up? So this is from a weekly report that Credit Suisse, the prime brokerage team, sort of sends out to their clients that invest in hedge funds. And it's like a lot of statistics, basically sort of detailing sort of changes in gross and net exposures held by the funds that use Credit Suisse as a prime broker. So what was interesting about this week's issue was that they tried to sort of measure emerging markets exposure among the sort of fund within the fund universe. So this first graph, it's showing how it's just graphing over time the net exposure to EM by both long-short equity funds and by macro and CTA funds.
Yeah. So, and can I just interrupt for all the people who are watching? I know most people watched us on 350p or whatever the default is on YouTube. Just turn the dial up. It's a little gear sign on the bottom right. And just turn it up to 720p, and you're going to see the charts just fine. So, yeah.
I mean, what's interesting sort of about this chart is like the very divergent paths that sort of net exposure has taken between the two strategies. I mean, we often talk about hedge funds as if, or the hedge fund industry as if it's a monolith. And actually, there are very, very different sort of factors that drive the performance of different strategies. So you really, I mean, it's useless comparing a fixed income arbitrage fund with a macro fund, for example. It's
But people do that all the time, don't they? I mean,
yeah, of course, because it's easy and yeah.
But what do you think when you read? I mean, we're going directly on hedge funds. The reason we started talking originally was hedge funds, and people, I think, we're one of the few people who publicly praise hedge funds and the risk-adjusted return. What do you think about when you see like these broken down strategies in this chart? But can you? I mean, I don't mean to.
I mean, this is it's a broad topic, and unfortunately, sort of the time's limited right now. But I mean, Sverre, one of our plans is to do like a hedge fund show, hopefully sort of on a weekly basis, and then we'll be able to talk about this stuff a bit more in depth. But I mean, the show today is structured research, but I just wanted to sort of bring up, since we're going to be talking about emerging markets, I wanted to sort of bring up just these two charts that were in the Credit Suisse report this morning.
You want to bring up the next one? By the way, can you just check the chat? There was one setting that the last one, the chat in the drive.
Okay, hang on.
I'm going to bring up the next chart now.
Okay.
So it's a little intermission here.
All right.
Are you getting the chat up?
Yeah.
Yeah, okay. Just so you know.
Okay.
And we're bringing up the next chart here.
No. Keep this one, keep that one, go back to the previous one.
Yeah.
Okay, so the point here is that during this sell-off in January, global macro has been reducing sort of net exposure in emerging markets, whereas long-short equity funds have actually been adding net exposure.
Yeah.
Now, what's not clear is
what do you mean? What does this entail?
Well, first of all, for macro, it's quite logical because macro are primarily trend followers, especially CTAs. So that makes all the sense in the world. Long short, it could be saying one of a number of things. It could mean that hedge funds have covered some of their shorts, and so that's why the net exposure is going up. Or it could be that they're bottom picking and adding new longs. Now, people should sort of bear in mind that this refers to sort of net exposure on emerging market equities. So it says nothing about FX or rates.
Would you use this to select trades and select funds when you use or when you choose investments? Would you use data like this? Because this is data that normally wouldn't be released.
This is more interesting sort of inter-month data. Just to tell you sort of how what you want to look for are changes in position. So,
but is CTAs more prone to? They seem to be more jagged. If you look at the chart here, are they more prone to, like you said, they're more prone to trend following? Are they a better gauge for next trends?
And Credit Suisse, I mean, CTAs are trend followers. Within macro, that's like quite a broad category. You have quant funds, you have discretionary macro, you have more systematic strategies. So, unfortunately, Credit Suisse doesn't differentiate sort of between the two. So it's not really, it's just a nice chart, but it's one data point. But it's difficult sort of to draw any kind of actionable conclusions, just from this on its own. But it could be the case, looking at this, it could be the case that equity long-short funds are starting to dip their toes into EM equities again. It could be the case. It might also be short covering.
Yeah, that's interesting. But what would you do with this? Would you make a decision if you're going to use this individual?
No. I mean, this is just used. This is just a backdrop. I mean, hedge funds only price once a month.
Yeah.
And between the monthly mark, a lot of things can happen. I mean, we're regularly getting weekly estimates, but this just adds color to sort of what's going on.
Yeah. So you want to bring to the next chart?
Yeah.
So this is our next chart. Can you explain it a little bit? I'm going to bring it up full screen
Sure,
for you.
sure. So this is, again, for long-short equity funds. It's net exposure, but broken down per EM country.
Yeah.
And we're talking about equities again. And what's interesting sort of about this, the red dots are January 27th, blue dot is December 31st. Now this is the average, net exposure. And what's interesting is that net exposure to Brazil, India, China, and Russia is higher than where it was at the end of the year. So this could sort of lend some support to the point that I was putting forth before, that maybe long-short funds are sort of starting to bottom tick in EM.
That's good. So EM shares, like EM equities.
Yes, EM equities, yes.
Yeah. So how does the EM debt look in your point of view?
I haven't seen sort of any data sort of there.
But it's not necessarily positive. I mean, the story
No,
is...
of course, of course not. I mean, all of the estimates that I'm seeing sort of on the EM focused funds are negative.
Yeah.
And
yeah, that's what I mean. That's all I'm seeing as well. But I know you have a much broader perspective.
Yeah, but that's been a difficult space since the summer.
Yeah. Well, since May, really, wasn't it?
Yeah, exactly.
Yeah. No, it's been very hard, especially for the EM only funds. I mean, it's very hard to generate alpha when the roof is on fire. I mean, it's quite
exactly.
rough.
Exactly. So, I mean, I don't, I invest primarily in hedge funds. I don't invest, although there are some small exceptions in equities or fixed income. But it's really, really important to just follow the research, keep up with what's going on in markets, and because it does help you in terms of monitoring positions. And it also sort of helps you to have a good dialogue with your managers.
Yeah.
So,
what kind of are you allowed to talk about who you prefer over others? Can you say so? I don't know what your. I mean, I'm sure there is a lot of secrecy.
in terms of the research, or in terms
in terms of allocations. How do you choose allocations?
Oh, again, that's that's quite sort of a broad topic. By the way, I am working, and I do have a hard out at the top of the hour. So
hard out, that's right.
Yes,
industry
the terminology. I learned that from you.
Yeah, that's the industry terminology for. So let's move to the Goldman chart.
So why don't we go to exactly. So I mean, this is the point about this this chart is we tend to talk about EM as one asset class.
Yeah.
And it's really not. I mean, you have emerging market equities, you have emerging market credit, you have fixed income or sovereign sort of debt, which can be both issued in local currency, or it can be dollar denominated. And then you have the CDS and FX. So, and you have different things that are driving sort of each one of these sub asset classes.
Yeah.
So it's really important to sort of keep that straight. And if you look, what I find interesting is EM equities. Now, I mean, most people probably don't know that emerging market equities have more or less been in a bear market since mid-2011. If you can draw up a chart of the EEM, so that's the MSCI emerging markets, the ETF.
Do you want me to bring it up from
yeah,
from the market?
Can you do that?
Yeah, just caught me off guard there.
Okay, sorry.
Yeah, no. I
forgot to mention that.
That's the iShares one?
Yes.
What do you, okay.
It's as simple as EEM.
Yeah. Here you go. Is that the right chart? So, by the way, if you're seeing low resolution, please change the resolution to 720p.
Yeah. Can you zoom out and do like a 5-year or even a 6-year view?
This is all. So back to 2007.
Okay, no, that's not going to be good. But go back. Can you? Yeah.
There you go.
Or at least. Okay.
There you go. That's a 5-year one.
Yeah. That one is probably better. But the point I wanted to make was just that they peaked in May 2011, and they're now down 21% from the peak. So
you know, do you want me to do it from May 2011?
Yeah, that's fine.
Now we get to see this.
But this is the definition of a sideways market.
Yeah.
I mean, you've
a very good example. So I can see here. You see the. Now you also get to see this lovely sponsor of ours. So this is how you use this product, and it's down 18%, as you can see from the right axis. If you can't see it, HD, change to HD. Anyway, continue.
Yeah. So, it's gone nowhere, and I think Goldman and others as well are just drawing attention to the valuation gap that exists. So,
I think that's actually a very good idea, and it's a very ugly chart, remarkably ugly. This chart. I mean.
Yeah, I mean when you consider this chart in light of everything that's been going on in developed markets, and the incredible sort of bull market that we had, the bull run that we had last year, this is not what you'd expect to see.
No. So you're a few minutes away from your exit point. So exactly. Let's continue.
Okay, I'll continue. So over the past over the past 2 days, really, various banks, they've been issuing all kinds of research. You see all different types of acronyms being sort of floated out there. And I just wanted to sort of draw attention to sort of a couple of the reports. I mean, the problem for central banks in EM is they're really caught between a rock and a hard place, because they have one instrument, which is the policy rate, which they have to use for two purposes. First, to defend the external balance, and then second, to kind of manage their own domestic growth. And achieving balance between these two kind of divergent aims is difficult.
Yeah.
Maybe you can go to the Goldman chart with the picture, the levels of the local currency debt.
Is it this one? No. Okay. No. This is what I got. I'm not sure if I have it here.
It's called Goldman Estimate of Yeah, that one. That's the one. You just had it.
Oh, yeah, I was on. Sorry. Confused me a little bit. Yeah.
Okay. Yes, that's the one. Okay.
Yeah.
So.
That is an excellent chart, though. Jesus.
Yeah. Yeah. I mean, sort of. This is. Within EM, I guess the biggest sort of change over the past 5-6 years has been a huge increase in the issuance of local currency debt, because these countries have traditionally sort of funded themselves through dollar-denominated debt, and this is the first kind of crisis where we have such a huge amount of local currency debt available. And you can look at a country like South Africa on the graph. I don't know if maybe you want to point it. If you can point it out with your mouth.
It's the fourth. No, I can't. It's the fourth from the left.
It's moved from about sub 10% levels.
No, it's less than 5.
Call it around like 8%.
No, it's less than 5.
Yeah. Okay. In 2007 to like around 30%.
Yeah, 25,
today.
Yeah.
And LCD, local currency debt, it's really like a double-edged sword, because the positive impact is that, debt redeemed in currency controlled by the central bank is, it doesn't impact the sovereign balance sheet. So, the central bank can, if the central bank sort of devalues the currency or takes steps to devalue it, they can pay they can pay in local.
Yeah.
The negative aspect is that it does lead to more FX volatility because foreigners have to then hedge their exposure.
Yeah, and that's what we're seeing now. I mean, it's a very volatile market now in the last just few days.
Yeah, so it can, for countries like South Africa, for some of the other sort of high current account deficit countries, it can sort of add to the pressure.
Yeah.
And, another sort of data that Goldman was highlighting was, of course, foreign currency reserves. A lot of people have written about this. Argentina and Turkey are the kind of two standouts, the two mauvais élèves, as you say in French.
What's that called when it comes
to reserves?
What's that called in Spanish?
No. No
it's more
Spanish
apt.
today. But the positives, and because we don't, everybody is talking about contagion, and the positives today, as compared to 97 or 98, is you have like a lot less foreign debt exposure.
Yeah.
And you have floating currency regimes.
Yeah.
So, yeah.
But let's move on. I mean, it's a very interesting topic, and we have so much good stuff here. So.
Yeah. So the next one is the picture of the current account deficits.
Yeah.
Okay. Yeah. So what I want to make sure I'm looking. Yes. Okay. So, there's been like a lot of. I love these acronyms and Federal 5.
Did you hear Ed?
I mean, I think it was Morgan Stanley that brought this one out, sort of.
But
like
did you hear
ago.
Ed brought out a new one I hadn't heard of. I don't remember what it was, but it was like bats or it was something.
There was one I saw mints the other day.
No, it was. It started
I'm not sure
with.
What that is.
It was like it was a. Oh, it was a good one, but if you go back and watch the broadcast with Ed, you can see it. But anyway, I cut
But
you off.
again, this is equities,
yeah.
And the point is that if you want to invest in emerging market equities, you have to keep an eye out on the current account deficits because it's what's driving the performance.
Yeah.
What has been driving the performance since May.
Yeah.
So the blue line is the surplus markets. So China, Korea, Taiwan, Malaysia, Philippines, and then the fragile 5 is in the gray. And we see a huge, difference in performance.
Yeah.
And previously they had been all of these markets had been quite highly correlated, and now we see sort of differentiation. So what this is doing is it's setting, once things have like settled down, this is like potentially sort of setting up some interesting relative value opportunities.
Yeah. And that's kind of something you've been focusing on lately, isn't it? That's a great way to find alpha, as far as I understand.
Yeah, absolutely. I mean, it's a different way of investing than sort of thinking about markets in directional terms, but it really, really worked well when you have like big dispersion within an asset class, and you have like a well-defined group of winners and a well-defined sort of group of losers.
What would you be long now?
Well, actually, I went back. I did one thing sort of yesterday. I went back and I looked. BNP Paribas, they published at the end of last year their 2014 EM outlook. And I mean, it was a really sort of interesting report, sort of full of some good ideas. And the point that they were making about relative value opportunities in EM is that it's not just a question of buying sort of good countries and selling the bad countries. I mean, if you, that leads to all kinds of problems with carry but what you need to sort of look at instead is the rate of improvement. So who is like moving from bad to sort of good, and who is going from bad to worse? And one of the sort of trade ideas that they sort of brought out for 2014 was to be long India rupee and short Turkish lira.
Yeah, that's a good one.
And that's worked out quite well.
Yeah.
And some of the other ones, maybe faster sort of than was expected. Yeah. And some of the other ones were sort of short Brazil, long Mexico, and long Poland, short Hungary.
Do you think these are still good, or is it about time to take profit on that?
Well, they moved a lot. I mean, I was listening to sort of Ed's comments regarding Hungary, so maybe that one sort of still has some room to go.
But we are 2 minutes from the hour now, so
so maybe just the last picture, which is just underlining my previous point about looking, the relative value sort of trades are most profitable sort of during times when you have sort of big dispersion within sort of the asset class across countries. Yeah. And last year was like one of the lowest, really sort of one of the lowest dispersion years. So, it could be sort of in 2014, maybe, not now, not next week. Maybe it's a second half story, but I think we're going to have some interesting relative value opportunities coming up in emerging market equities.
I think that's a great idea.
So you have to use like sell-offs, like yesterday. You have to use these risk-off sort of periods to sort of do your homework and figure out, where you want to be positioned.
Would one of these positions be Greek debt, like I know you've said publicly before?
Yeah, I mean, Greek debt is being sold off like everything else, and yeah, I mean, Greek debt will be. I'm quite bullish on the Greek 10-year, and at the current levels at 67, yeah, I would consider it an attractive long. I mean, I'm not giving sort of trading advice.
Yeah, we have a disclaimer somewhere. I don't know if it's actually
exactly.
public.
And the thing is, the last point is, on Twitter there are some fantastic sort of people covering emerging markets. Yeah. People that tweet under their own name, like George Magnus and Mark Dow, who I know you've had on the show before. And quite a lot of other very, very smart people, but that are tweeting on under sort of pseudonyms.
Yeah, and if you they follow you, they probably know who those people are by retweets or communication. So
exactly. So
right. It's a good source for EM stuff because there's not that much EM. I mean, if you read something like orange newspapers or pink newspapers, you generally, I don't get a nice sensation of EM, but these guys, these specialists, are much better in my view, and I'm betting it's the same for you.
Yeah, definitely. They're definitely sort of a resource that people should be using.
Yeah, brilliant. Okay, I think that's about it. I want to thank Michelle for taking time off, and we're about 1 minute over the hour, so you really have to go.
Okay, so I'm fine.
So we're going to keep the stream on for a minute or two, but we're pretty much done for the day. So thanks, Michelle, Ed.
Okay, thanks a lot.
Harry.
I'm just going to sign out here.
Thanks.